Good afternoon. First of all, dear readers, viewers, wish you a very, very happy new year. It's great feeling, coming back to you every year in the January, run up to the big event of Union Budget schedule on the 1st February and trying to learn from the BFSI leaders in terms of their expectations from the budget. Whether it's an interim budget, whether it's a full-fledged budget, the narrations could be anything, or maybe BFSI leaders are expecting A and maybe they're getting B, or we want X and maybe we'll get something else. But it's important to raise our voice and ask, whatever that we think is important. And since we are catering to the BFSI audience, we think that none other than the BFSI leaders who are actually catering to the larger audience through their policyholders, through their policy, through their customers at large, understand the things really better in the BFSI space. So we'll try and decode here in terms of what are the expectations that the BFSI sector has, specifically from the finance minister, which is going to deliver a budget on the 1st February of next month. So, dear viewers, we are going to have top four leaders here from the BFSI space, and we would also like to have your questions as well. So, please feel free to share your questions, and you can watch this particular live show on any social media platform of the etbfsi.com, starting from Twitter, LinkedIn, Facebook, and YouTube as well. Do share your questions if you have any. And I'm just starting with the introduction first. So let me introduce you to the top speakers that I have here. I have Rajiv Yadav, the MD and CEO of Fincare Small Finance Bank. Rajiv, glad to have you. My next speaker is Mr. Tapan Singhal, the MD and CEO of Bajaj Allianz General Insurance. Tapan, glad to have you.
My honor, Amol.
Thank you. My next speaker is Gaurav Kapoor, Chief Economist and SVP, IndusInd Bank. Gaurav, glad to have you.
Thank you, Amar. Look forward to the discussion.
Thank you. And my next speaker is Hardika Shah, MD and CEO, Kinara Capital. Hardika, glad to have you.
Thank you so much for having me, Amol. It's always a pleasure to see you.
Thank you. Thank you so much. So I'm also excited to learn, a lot of things from you and specifically the expectations from the budget. Uh, so currently, when we look at India, it's a bright spot. It's a rising star. Any commentary starting from the JP Morgan or Morgan Stanley or India ratings or Fitch ratings or Moody, everybody is betting really, really high on India. All the economy frequency indicators are absolutely positive, and they're talking great things about India, which is very positive. In fact, we have climbed the ladder of the $50 trillion economy, and we are actually moving towards the $3 trillion economy, which are all the bright spots. But still, there are a couple of challenges, such as the private capex cycle is not up to the mark, the export growth is still not there, insurance penetration, the consumption aspirations, all these challenges are also there. So, amidst this, my first question to all of you is what is your checklist from the budget 2024? What is it that you expect? And Rajiv, I will start with you.
Thank you, Amol. So I think, as you rightly said, I think there's 2023 has been a fairly great year in terms of economic rebound in a lot of aspects, but there will be aspects which will be still lagging. And I guess this is the first full year of post-COVID where we had normalcy across businesses. So, and we have seen that in the BFSI space that institutions have largely delivered great business outcomes. Also, it's an increase in interest rate cycle, but from a financial performance of the banks and the non-banks, specifically, if we look at that from that space, we have seen clearly, great performance in terms of credit quality management and economics management overall. So we are hopeful that the bank's balance sheets are largely cleaned up. There is appetite for growth. The credit growth is outpacing the deposit growth, so there is a lot of credit appetite which has got built up in the COVID times. And to your point, I think the infrastructure push of the government in 2023 is clearly driving some of this growth, which should hopefully now follow in consumer growth and in the private capex growth. From our perspective, when we look at it in a limited context of our banking space or a small finance banking space, clearly the digital focus of the bank is very helpful. So, when you look at a checklist or, from our perspective, we say digital push should continue in various forms. It's been the bedrock of the transformation which this country is seeing. There should be, there has been a lot of programs towards financial inclusion agendas, and we've seen the benefits of that flowing to the rural segments and thereby to the economy. Sustainable finance could be another interesting agenda for the years to follow. MSME, which has been a huge focus item of the government, and clearly our country is largely an MSME driven economy. Some programs to further that cause could be very helpful. Besides continuing the infrastructure push which the government had started, in the previous year, large scale, and in the earlier years also, I think that could be the broad checklist for the budget 2024.
Okay, sure, Rajiv. Meaningful thoughts there. Tapan sir, let me come to you and understand the insurance perspective and the insurance checklist.
So, Amol, first and foremost, I think, as an insurer, our job is on the protection side in terms of looking at if things go wrong, how do we stand and try to correct that. So, if we look at our country, as you rightly mentioned, everybody is talking about our growth, about our, the next decade is ours, or the next 2 decades is ours. And one of my learnings has been over time that when things are going good, you should also focus on what can be better. What is it that is pulling it down? So if we have all the parameters being talked about in terms of what is taking the growth to the next level, do we have sufficient discussions happening on what is pulling that growth down, and how much is it affecting the growth? So let me give you a case in point, a simple one. Let's say health for all. What impact does it have? And we have all this reports from World Health Organizations and other places that in India about 7% of India's population goes below poverty line. That's about 10 crore people because they can't afford health expenses. To bring 10 crore people above poverty line, it costs you 1.2% of GDP. If you try to put that on. If you look at Sikkim floods and you look at Chennai, and Sikkim disaster which happened. Now, if 100 rupees is the loss due to catastrophe, about 6-7 would be insured, would be paid. About 5-7 would be paid by the government. About 85-90 just goes down, and that brings down the economy at a very rapid pace. Compare it to developed markets. In those markets, if a loss happens like this, their actually economy moves up. When 95% is would be insured, or there will be money pumping back into the region. So you have employment generation, you have stuff coming in, rebuilding happening, it moves up. So I think a lot has to also be talked about what is pushing our growth down. So a 5.6 or 6 looks attractive. Could it have been 9 or 10? And this is after the push which is going down. So one is that do we look at what all is pushing our growth down, and do we address that? Second issue for a country is, if you again see, is the adequate social protection in terms of or social security, whatever you call it. There are some ifs and buts, and there's some small portions here and there. But overall, are we thinking about it? Are we thinking about the aging population? What we talk about demographic dividend across the world, people are worried about aging population. Be it Europe, or look at China now, they're going to hit the reversal. But in India also, the number of people above 60 is going to be huge in times to come. And now we have them staying alone. The joint family over time is going down. So to give you a case in point, let us say if aging population is a concern, a simple thing like health insurance for the aging population, and you have a tax exemption, which let's say gives you some amount if parents are covered in a policy, if they're below 60, over 60, and there's 50,000, 25,000. Is it sufficient? What loss will happen to the government if that they make it like unlimited? What do you spend on anybody over 60 for health? In terms of it, the exemption is like unlimited. You buy a 10 lakh policy or 5 lakh policy, it should be there. So how do you encourage the social security issue via the budget, and how do you address the concerns that is going to come in the country? Are the big issues that should be discussed about and brought into the budget. So while we have this upswing and the euphoria of what is going good, but in times of euphoria and when things are going good, please do focus about what the misses are and address it before it blows out of proportion. I think that would be something that would be coming first, recall in my mind.
Sure, very realistic thoughts. And when you mentioned Sikkim, the Japan example is just in front of us. It's not even a week old unprecedented events, natural calamities can happen any point of time. So, very realistic thoughts. We'll come back to you and maybe discuss more in detail on the social security and all. But let me bring Gaurav here and bring an economic perspective here. So, Gaurav, we are waiting to hear you now in terms of your opening remarks, specifically from the budget
I think,
expectations.
Amal, as you pointed out, I think for me, as an economist, I think the most important area where the government needs to focus on going forward is to accelerate the pace of fiscal consolidation. So, the economy is recovered from the pandemic fully. We are actually growing. In the first half, the economy grew at 7.7%. Second half is going to be somewhere around 7%. Full year around 7%. Next year, at least 6%, which is double the rate of global growth. So the point is that okay, while these and some of this is on account of the fact that the government has a major driver of growth has been public capex. If you look at the contribution to GDP growth across, I would say in the last 6 to 7 quarters, it's predominantly coming from public capex. There are signs now that private capex is kicking in. Residential investment is one of it. But even otherwise, I think there are signs that corporate investments are in certain sectors picking up. So these are the times when you need to build back policy buffers. If you look at our policy response to the pandemic, on the monetary policy side, we saw the policy rate, the repo rate being cut by over 250 basis points, and liquidity worth almost 8% of GDP injected in the system. Now, all of that has been taken back. In this year, we've ended the year. In fact, in the third quarter of the current financial year, after 18 successive quarters, the banking system was in a net liquidity deficit. Now, which means that we fully withdrawn the stimulus. We know repo rate has been raised by 250 basis points. Last 5 policies, we've not seen any change. So effectively, monetary policy has kind of gone back to a point where the stimulus has been withdrawn, and gradually we'll move to a point where we'll be in a position to ease rates a bit. Now, the government's role from here on is to, one, reduce the size of its fiscal deficit, because that has added to the market borrowing program of the government. Prior to COVID, the government was on average net borrowing was somewhere around about, for the central government, was about between 4 to 5 trillion or 4 to 5 lakh crores. In the last 3 years, it's gone up to about an average of 11 trillion. And if I go by the fact that next year, in the next fiscal year, if the government targets a fiscal deficit, let's say, of about 5.2% of GDP versus 5.9% this year, keeping in mind that the finance minister has set a target of taking the fiscal deficit down to 4.5 by fiscal 26, which is the next fiscal year. You basically you still end up with the central government borrowing close to about 11 trillion. States borrow another 6 to 7 trillion. Those state finances and the central government finances on the taxes side have seen a significant improvement, mainly on account of stabilization and improved compliance on GST. But that being said, the spending, the size of the budget last year was 14.9% of GDP. In the pandemic year, when the stimulus was initially given, the size of the budget was 17.9% of GDP. Now we've come down to 14.9, but pre-pandemic year 1920, the size of the budget was 3.4% or 13.4% of GDP, which means that over the next 2 years, you need to reduce the size of the budget by about 1.5% of GDP. Now, on the taxes side, our tax base for the country with the per capita income of India of about roughly $2,300 is actually not that bad. I mean, at 11.5% of GDP, compared to some of the other larger economies within Asia, which have a similar, which have significantly higher levels of per capita income, the tax to GDP ratio is actually at par or slightly better. So in our case, of course, that being said, of course, GST needs to you need to simplify the GST to increase the tax revenue coming in from there even more. But the point is, on the taxes side, there is limited room to maneuver. One being the interim budget, two with many changes being made since 2018 in the corporate tax code and then in the personal income tax code, and now GST being outside the purview of the budget itself, it leaves the government basically to ensure that they reduce the size of the spending, but at the same time, do not compromise on the quality of the spending, because
Great.
public capex is critical to keep the economy going. This year, the target was 10 lakh crores, or about 3% of
Exactly.
GDP. Now, this would be challenging. I think going forward, if you have to curtail the fiscal deficit at the pace at which the finance minister is talking about, which is roughly 75 basis points of GDP per year this year and the next, versus
Hmm.
about 50 basis points in the last 3 years, you will need to cut down on spending, which means that, and given the fact that the revenue spending overall, almost 65% of the government spending is largely committed in nature. One third of the spending is interest payments. So that's why, that's the other reason you need to bring down your borrowings, so that you can, it increases and gives you the fiscal space for the government to continue with the capex. And basically, and given the aspirations we have of becoming the global manufacturing in hub, you need to focus on improving not only the hard infrastructure in the economy, but also indicators like health and education. I think that that's
Hmm.
something which has to be the focus going forward, because an economy which is demographically advantaged as we are,
Hmm.
and demographic dividend runs for another couple of decades at least, you need to make sure that the quality of labor and the quality of our resources, of human resources, improves. So I would say I would stop at this. I think my
Sure.
primary, as an economist, would be the government follows an accelerated pace of fiscal consolidation, so that the cost of borrowings overall comes down. Public debt to GDP, which is touched 80% of GDP, that you have to ensure. Anything above 60% of GDP retards growth. There is enough
Right.
evidence to show that. So I would say that is my initial take on what I would want to see being the interim budget, and even
Yeah.
going forward, I think that would be my first ask.
Oh, sure, Gaurav, you highlighted a couple of points. We'll certainly come back to you and speak about the GST fiscal deficit, and more importantly, the infrastructure pipeline. We kind of applauded when governments said last time that 10 lakh crore is going to be the public capex, and we could see, in fact, a lot of roads are nearly completed, and not only just roads, but the whole Bharatmala and Sagarmala, ambitious projects. But I will come to you, Gaurav. Let me go to the Hardika and take her opening remarks specifically on the NBFC side and overall SME, MSME. What do you expect, Hardika?
Yeah, I mean, I'll pick up from what Gaurav is talking about on one side on this liquidity crunch, which
Right.
felt at the NBFC level. We talked about banks growing. NBFCs have grown 3 times of banks in this last year because of credit. The demand for credit has gone up, which is a great sign. It's a direct correlation to the GDP growth, to consumer confidence, to people buying stuff. But the two areas that I feel that I would love to see, if you ask for that checklist, I would love to see some momentum. One is on the manufacturing side, which was, which Gaurav, hinted at as well, that we talk a lot about this ambitious target, right, of contribution of MSMEs to go from 30% to 50% from a manufacturing side. We need to then enable that. And so we'd love to see something in the budget that really pushes that, because that's where I don't see, even in our customer, demand is coming up for asset creation or investment in real assets, but I'm not seeing that at the level it probably could be if there was some supporting, enabling infrastructure around it. And maybe that's something we'd love to see in this budget. The second thing, which is, this is a two-part, right? We talk about high demand of credit in the country, growth of credit in the country, and yet a liquidity crunch. And at the same time, we have taken away ease of investment for foreign investors in India. That piece, I mean, this whole withholding tax at 5% arbitrage that was made available for the last 10 years went away this past July. And it would make complete sense if our banking system could absorb that, and then we need not depend on that foreign investments to come into the country for that for that liquidity. But that's not the case. So I would love to see something being done in that space of how do we enhance liquidity in the financial services ecosystem, from FPI or banks to NBFCs, or to the last mile, from an MSME perspective. And that's, I think, a very important element if we want to continue this growth journey that we're on.
Hmm. Sure. Thanks so much, in fact, all of you, for sharing meaningful highlights here. Let me just get into some specifics now. with each one of you, and maybe if I have any questions from the audience, I will take that. So Raju, let me come back to you. uh, RBI clearly said, almost I think 5 to 6 months back, that the pause to pivot and withdrawing accommodation stance, but we didn't see that translating specifically into the capex cycle of the corporates. I know you're not directly catering to the large corporates, but even if you take an example of the mid-size or the SME level of the corporates, in fact Hardika highlighted the manufacturing part. What is going wrong? I mean, despite so much of the positivity or optimism over the economy, the capex cycle has not picked up. If you, what could be the reasons, and what is it that the government can do now, maybe to push it to the next level?
So I think Amol, this has been a very tough year. We all know economically it's been a tough year worldwide and in India. So at the larger backdrop, we are, with however much positivity we have on a lot of macroeconomic variables, but the largest message in the economy is that we are at the highest interest rate ever worldwide, and the kind of rate increases that we have seen, and therefore the impact on consumers and their EMIs and everything has been quite significant. And this has been and very high inflation on the other side, which sort of eats up into the real returns for the share for the depositors, or for the inflation which impacts the consumer spending. So I think this has been a very tough year. It has a lot of variables have kicked in to give the growth. But when you think of private capex or consumer spending, I think there will be some lag for the confidence to build in, because if the private capex were to come in at current interest rate, these are still very high interest rates, which will impact the IRR of the project. So I think it's just a question of the government spending coming in, and the buoyancy back from COVID, and the stabilization of the balance sheet, and we are seeing the increasing credit demand. But my guess is, if 2024 plays out as most of the global central banks have sort of talked about, where probably the rates have peaked, probably there is a likelihood of the rates declining, and if that confidence starts seeping into the private sector from a capex side, or from a consumer into the consumer spending side, I think we should see more progress in 2024, and that could be the year which actually this variable also transforms to the positive side of things.
Okay, sure, Rajiv. Let's hope on that front. So, Tapan sir, let me come back to you, and you gave a great example of Sikkim and other floods, and also the social security. My question to you is, generally, in the last quarter of every year, people go to buy insurance policies only to save tax, right? What could be the other, maybe other incentives that the government should, perhaps give to the insurance? Because now we have reached at a level, and we also understand after the COVID that how important insurance is. So that should not be just part of ATC, ATE, and ATD, but everyone should look at it as social security. So the government has done couple of things for the crop insurance, done couple of things for the health insurance, but it didn't scale up. So anything specific, to one, boost the social security apart from typical, tax brackets and incentives that you think government should do, considering even the natural calamities will create a lot of disturbance and people will wipe up all their deposits and savings.
So Amol, on taxation now, I've stopped speaking about. As an industry, we always believed that insurance is not a luxury commodity that people buy, which you should be taxing at, let's say, 18% kind of rate, or let's say even at the capital tax that we pay as general insurance is the highest in terms of 25% all that we pay. So I've always had a strong opinion that we confuse insurance is supposed to be helping people. It is not a luxury good. So now I've stopped talking about it, because after so many years, we didn't see much of a progress there. So now I look at a different angle to the way it has to be. What problem are we solving? And as government, what can we do to solve the problem? In a way that doesn't affect the treasury of the government. So I think they also have their own constraints. So to be fair to them, so let's look at a perspective on health. As you rightly said. Now, on health, how can the health premium come down cheaper? The missing middle, as you call it, 70 crore Indians are not covered currently. The below poverty line still have a cover, and some, I think, well-off people have some. 70 crore Indians still don't have a health cover. Now, there are two models to it, which I have been recommending over time. One, if you look at it, in a country like US or developed market, is mandatory for employers to ensure the employees that they have. It's mandatory, like you have to, because health is something that should be done. Now let's look at India's context. If it's expensive, it's a burden to the employer. At the same time, state governments have health cover now. It has picked up, and I was very happy to see the election manifesto. Quite a few parties have mentioned health for all. I was very happy to see that at least that progress has happened to this level. Now, state governments have health, which they're providing below poverty. Tender comes out, and the average ticket size for a 5 lakh sum insured for a family comes to about 1,600 rupees to 1,800 rupees, somewhere is 2,000 rupees, for the whole year, for the family coverage. Now, which to me is very, very reasonable. So let us say for people who are not below poverty line, and can we say that once we make it mandatory for employer to insure all employees in the health, and they can access this rate? So it actually becomes like, if you look at divided to per month, if it's like 2,000 rupees, what are you talking about? You're talking about less than 200 rupees. You're talking about 150 and 60. Who even let's say if you have house help also, Amol, you can afford that to insure everybody. So now it's not costing exchequer to the government. Just this policy changes and the philosophy that we look at solving this can actually give a huge boost to ensuring that our GDP, which I say the leaking bucket of about 1.2 to 1.5 GDP happening, but we are not covered. And point you mentioned about, and Gaurav mentioned about how to look at the human that we have and how to take care of them. It's taken care of. A simple thing. The second thing, let's say when pandemic happened, we all spoke about the next pandemic coming, and we all spoke about we should do something, we should be prepared for it. Today, if I ask you, is there any discussion on that? We already see the variant of COVID again coming up. We see that in the newspaper every day, happening, that number of cases on the rise. Though we see that it is not so dangerous as it was, it is still mild. But can anybody in the policy making or anybody say that a pandemic like COVID would not hit again, which is really dangerous? And when will it hit? Can we say that? Now the discussion has disappeared. The pandemic pool creation, and it cost 12% of the GDP, in the time of COVID. We know the kind of cost it was. Is there any discussion happening on that?
Right.
Is there discussion happening on the pandemic pool creation? Is the discussion happening that if it happens, the preparedness on handling pandemic, is it being done? Third point, as I mentioned earlier also, when I was a child, in 8-10 years, we used to have this rainy day in which we used to get a leave and from school, and we used to be very happy because the school would get shut down, and that would be for us as childhood memories. Making those paper boats and all was such a. Today I look at 8 events in a year. It's unbelievable. This year we had 8 catastrophic events in a year. It's a fact. Climate change is there, not only in our country. Look across. Now, if it is there and you are having huge losses, state by state, if you pick up, and the gap is 90%, 94% in state in terms of what is being provided. What's the thinking that we are putting together to do so? Let us say a simple thing like a bit of a property tax, creation of pool, creation of parametric. Tools are available. You have models across the world which is being worked upon. So now, instead of talking about tax rebates, which I think we spoke for many years, these broader problems have to be addressed, and they're already on before us, is looming ahead. Well, we can't keep our eyes shut, and budget is the time where we should at least think about the serious part, along with all this expenditure, the fiscal part, which Gaurav and Rajiv and Hartika are mentioning. But this part to me is also a very substantial part from a country's progress and the development part which should be addressed.
Can I add something to that, Amol?
You also took a lot of holidays during childhood in the rainy days.
Well, that to what I think to what Tapan was saying. I mean, one more element of looking forward to me, and as a woman, I think that this gender parity in the workforce, right? We're talking about becoming this massive economy, and yet we are not able to keep women in the workforce. And it's not that we haven't done the support the girl child program or or schemes for women entrepreneurs, etc. But fundamentally equitable access, and which requires us from a society perspective. I mean, look, systemic changes, I'm going to put that aside. That's a very large topic, even for our government. But fundamentally, even if we can address security, safety, which is longer term, right? that those elements will also help. And I don't know how you put that in from a budget perspective, but we need to start thinking on those lines and I'm in concert with what Tapan is saying, that there needs to be more than an immediate thought. And I recognize this is an interim budget, but we need to look a few miles forward here.
No, agree. In fact, the budget commentary and the narration has also changed since last couple of years. In fact, they are also giving a broad view. If you look at last budget, they spoke about Saptarishis. They also spoke about millets, which is absolutely a different part, but they're asking people to be healthy. So here they should, I think, talk about insurance as well. I think a very valid point from both of you. So Gaurav, let me come back to you now. And the basic question, first of all, that I have is, how much do you think can government spend, considering they have already emptied their pocket on the infrastructure? On one side, we have a positive story that we have more than 1,60,000 crores coming into the kitty through GST every month, and in fact, it's getting a great collection. Obviously, inflation 5.6 is not again in RBI's target window, but GDP of 7.6% is again a positive phenomenon. Considering all these data points, which are again on one side very very positive, but on the other side, debt to GDP ratio is high, and the fiscal deficit is again likely going out of the targeted area. How much government can spend? How much is the capacity of government to spend this year, Gaurav?
See, as I said, I think you need to see in terms of the size of the budget, as I mentioned when I started speaking. Prior to COVID, the average, let's say, prior to COVID, the average spending of the government was between 13.5%. During the pandemic year, it went up to 17.5%. Large part of it, and since then, it's been gradually coming down to 14 about 15% in the current financial year. Now, the significant jump, the quality, when we talk of the quality of spending, the spending, if you see the quality, the overall composition of the government spending, almost 65% of the spending is committed, in which the government really can't do much. You have to make interest payments, you have to pay salaries, you have to, defense is increasingly becoming in the geopolitical order we have, defense spending is also equally critical. Pensions and salaries, and then subsidies and transfers to states actually leaves the government about 30 odd percent, in which they really have discretion in terms of spending. And there the focus has been on capex. So I think what you will see is, if prior to COVID, our objective was to get to the fiscal deficit target of 3%, which was the FRBM target. Now, of course, a pause has been taken. The finance minister has set a new timeline under which she wants to take it to 4.5 by 25-26, which requires both efforts from the tax side, but more so from the spending side. Now,
Yes.
as I said, revenue spending, there is limited room to maneuver, so you will have to. The axe will fall on capex, but hopefully, of course, this year the jump in capex was particularly large.
Yes.
From an average of about 7.5 lakh crores a year. This year the target is 10 lakh crores. The government has spent about 6 lakh crores till November. You have still a gap. In fact, significant spending coming up from now till March till March 24, which would translate into almost 40% increase year on year in this period, in this 5-6 month period. So there is a significant push already in the pipeline, and capex has a multiplier effect. And the center is also supporting states by giving them long-term 50-year-old loans to kickstart their capex, which has picked up this year. So I think the government is in a position to now start focusing on fiscal consolidation, achieving that 4.5% target, for which I think next year the FM may look to keep the size of the budget somewhere around 14.2 odd percent of GDP, which gives her about 70 basis points space, on the fiscal deficit. Because as I said, I think in a year when next year the economy, by any metric economy, next year is going to be growth is going to be somewhat slower. In fact, this year the government assumed, if I recall correctly, the nominal GDP growth assumed in the budget was around 10.5%. But in the first half of the year, the growth has actually been 8.6% in nominal terms. So But that being said, I think overall, as I think, assuming that the nominal at 14.2% of GDP as the spending overall, and tax to GDP of about 11.5% of GDP, which is doable. I think you end up with a fiscal deficit of about 5.2% of GDP, which is about 70 basis points lower than 5.9, and going in the right direction. And remember, next year, actually, on the borrowing side, a new source is opening up with this inclusion of the Indian government bond in the JP Morgan bond index, and likelihood of Bloomberg Barclays and FTSE Russell following. But ultimately, if we were to, but I was just looking at just before this conversation, I was just looking at the 10-year yields across Asia, and India's 10-year bond yield has been fairly stable at 7.2, but it is highest in Asia. The only country which has 10-year yield higher than India is Pakistan, which is at 14%. We all know what the state of that economy is. But in our case, I think there is a need to curtail overall borrowing so that the aspect of liquidity, which Hardika kind of pointed out, I think at the end of the day, household financial savings, which are available for the rest of the economy to invest, they are at about 11% of GDP. Now, if center and state put together take away almost 8.5%, it leaves about only 3.5% for the private sector to utilize.
Right.
And then, of course, and we are an economy where investment needs are larger, and we attract capital either in the form of FDI, which has been actually quite slow this year, but FPI route has always that's one route where we've seen a pickup, significant pickup this year. So basically, to ensure that to accelerate the pace of fiscal consolidation, you need to look at spending of no more than 14.3% of GDP, which is less about 70 basis points as a percentage of GDP less than last year, because you now really need to
Right.
push the pedal on consolidation.
Oh, sure, Gaurav. Appreciate your calculations, and 14.2 to 5 is a very decent and kind of an achievable number. Uh, Hardika, let me come back to you now. You spoke about liquidity, and I know, in fact, the segment that you're catering in very well. So give me a perspective in terms of what is actually happening with the SME, MSME, because I see a different commentaries. On one side, we are saying liquidity crunch is an issue. Second, we are saying that unsecured lending is an issue. Uh, Third, government is quite positive about the SMEs and MSMEs. In fact, they pumped in a lot of capital specifically catering to MSMEs. But still, there are a lot of issues with the manufacturing. Still, there are a lot of SMEs says that we are credit hungry and we are not able to access the credit. So one, what is the current challenge that the SMEs and MSMEs facing in terms of finance, and what is it maybe that the finance minister can do to address it?
Yeah. Oh, great. No, I'll definitely try to be the voice of our customers here as much as I can. I mean, look, on one side, I think that we are out of COVID in that sense that MSMEs are ready. They're geared up. They're operating. I mean, even at Kinara, we saw 150% jump in applications this last quarter during the Diwali season and just generally the festival season. However, what worries them is this is one, access to capital. We'll talk about that in a minute. But inflation, right? At this, everything is costing more. Raw materials costing more. The tax regime is not helping as there's changes in there. And we talk a little bit about there's been a lot of public investment or government spending for infrastructure, and some of that does trickle down to the MSMEs. But then on the flip side of it, because it is public investment or government investment, sometimes it takes way longer to get your money out. So how does one manage their cash flow when you're a small business and an MSME or an micro enterprise, and you're a tier 4, tier 3 supplier into something, and you just don't get that you don't get your capital back or your invoices paid in a reasonable amount of time. And then when you take that context, so inflation, you don't know when how long it's going to take your money to come, and you may want to buy a machine or invest in expansion, but you don't have access to capital, or you're not sure what that access to capital will look like. And that's where you get into this conundrum of how do I keep floating. one of the things that I feel, and this is one of my biggest asks, right, is, and you talked about unsecured in a unsecured lending has to be a focus area. Now, it has been, right? The government talked about the CGTMSE scheme. Every year we hear in the budget, there's mention of the CGTMSE scheme, and there is more allocation being given to the scheme. The whole idea of this scheme, which has been around for what, 20, 23 years now, is to enable last mile access to for unsecured business lending, right? To give MSMEs, which are priority sector, and to be able to have this backing so that when we go and give a loan, there's a back to back, some amount of guarantee that comes through, that we can then be able to access liquidity and access that customers and provide access to that customer segment. The challenge with this program is it went 2 years ago, it was capped at 14% to the MSME. I mean, cost of my capital is hardly less than that, so it is impossible to do it. Then it went back to 25%. Now it has just dropped to 21%. So there's a lot of confusion, volatility. And honestly, we heard today that interest rates are going up. So how do I service a customer when my cost of capital is at 12, 13%? At 20, 21%, and still be able to be eligible under this program where I have a back-to-back guarantee from the government, and therefore be able to service that last mile unsecured business loan where the demand is, where the customer is. So somewhere in there, we need a fix, right? We need stability, and we need a market fix, because it needs to really be aligned to where the market is of unsecured business lending, and not, sort of this arbitrary number that comes and goes every year. And even though there's allocation of that capital, I'm not sure there is as much utilization from the NBFCs because of it. So those are my two things.
Sure, I think meaningful one, Hardika. I think there are a couple of questions. I will start this with you only because you spoke about the interest rates, and the question is about interest rate. It's a broad question that I have received, more I think from a consumer perspective, but still, you can try, and maybe Raju can add later. Is there any way the interest rates could be lower? Is there any way that interest rates will be cheaper going ahead?
Yeah, I mean, look, I think that it can be, right? We're really talking about having more liquidity in the system, and therefore, good assets will get access to capital at lower rates, and then we can lend at lower rates. But when you narrow the pipelines of foreign investors, when you make it so difficult for banks with this now, the new RBI circular around unsecured lending, even though we are priority sector, for example, I'll speak from a Kinara perspective here, even though we are priority sector, even though we are servicing MSMEs and a business loan, banks are having to rethink all of the risk weightage, how it applies, are we in, are we out, etc. And it creates another sort of a freeze crunch again, right? So it can be lower if we collectively get behind the idea that MSMEs are here to stay, which we hear every budget, we hear this, and that there are all these programs that are being put together for it, which is great. But then we enable that programs through the existing ecosystem. We make it not just a policy thing, but an implementation thing. And that implementation thing is where sometimes I feel we have too much volatility and are not able to get through that, get through those layers. But that it's absolutely possible. We just need to make sure the liquidity pumping is happening from top to bottom.
Sure. Raju, Hardika mentioned on the MSME and specifically business side, but from a customer side, because FinCare also caters to the retail customers, is there any way that the vehicle loans, home loans, and overall personal loans will get cheaper going ahead? Anyway?
No, I am quite hopeful that this will happen in 2024. The reason being, we are seeing a trend towards a flattening of the curve on the interest rate increases, and hopefully some decline coming in later half of the year, and that should help immensely. The second variables are the credit cost. Ultimately, the interest rate is determined by a few variables, which is the interest cost, some of the credit cost variables, and the OPEX variables. The credit cost of a lot of the portfolios that we had prior to COVID or in COVID, they're at a levels which is quite benign at this point of time. So that should help. And the third thing is that because of the good growth rates over the last few years, the balance sheet size of almost all institutions are greater. So therefore, and that should lead to reasonable OPEX ratios. So, given these variables are trending in the right direction, all that we need is a little bit of another 6 months for some of these things to show up. But I think 2024 end, there can be some hope of it's a real decline in interest rates to consumers out there.
Okay, sure, Rajesh. So I have two, three more questions. One is on the health side, which I will compile, and then on the economy side, I will ask to Gaurav. So Tapan sir, there are two questions. I will put it in one bracket only. Do you think that the incentives to employers to offer health insurance will help? That is one. How can we get health costs lower when inflation is too high? This is slightly different, but if you can still take it. Two questions for you.
Okay. First, I think we should make it mandatory for all employers to have health cover for employees. It is very critical. See, it is also critical from a perspective of your management of people. So it's not about incentive. It is just mandatory. And a country like US has it. Well, it's nothing that we're trying to say out of the box. A lot of developed countries already have that. So that is the first point. On health costs getting lower, see, and I've already mentioned it before, there has to be a regulator of the hospital. And we saw a note, and I think I saw you or somebody mentioned, Amol, that the note which said from the cabinet secretary mentioning about regulators being set up for
Yes.
hospitals. So there has to be some kind of semblance. It cannot just go off the hook. And the second thing which I had also mentioned about is, and what we as industry are doing, we along with the government, National Health Authority, are getting into a platform creation in which the entire industry is plugging into, and we're looking at hospitals plugging into that, and a seamless flow of claims happening through that, which from a customer perspective makes it like a real-time basis, 100% cashless. So you are eliminating frauds, you are eliminating all elements of overcharging on the bill, and fairness and straight through of claim payment, and it's a very good initiative from a customer perspective. Now, if you are able to eliminate frauds, that brings the cost down. If you are able to make it like you widen the pool, insurance pool, you widen the pool, that brings the cost down. And lastly, as I mentioned, when we look at the tenders which are already there in state governments, if that price is accessible to the general public to be able to log in, and be able to take that, that brings the cost considerably down. So there are enough mechanisms to bring the cost down on a very substantially fast-paced basis, and which is very critical. It has to be done. Otherwise, you look at today for a senior citizen or somebody who's 80 years of age, the cost of health insurance is pretty high. It's pretty steep. In a way, it becomes like unaffordable for people, which is again a problem happening. So as an industry, I think we're looking at putting all this together so that we are able to keep the cost from our perspective very reasonable in times to come.
Sure. Thanks for answering that. Gauravji, the question is specifically, I think, about the spending point that you made. Since government can look at spending then very rationally, what are the areas that you think? What are the areas that you think that the government should spend aggressively going ahead?
Well, I think you need to continue focusing on building the infrastructure. If you look at the major areas where the government has spent, roads and railways are the two major ones. I think going forward, climate change and climate finance will also involve a bigger role for the government. While there's been a major push towards renewables in the economy, but the fact is that we are again reaching a situation where our demand, there is I think this year we saw the peak deficit in electricity consumption again increasing. So there will be, there have to be focus on building up, thermal power plants and to counter that, you will have to facilitate or create a mechanism of, public-private partnership in climate financing, because I think by 2030, as per the estimates which have been released by COP28, I think about 5 trillion worth of investments are required for the goal of reaching net zero. Of that, 3 trillion is by advanced economies, about 2 trillion by emerging economies. So the government will have to continue focusing, and of the 2 trillion, you will have to get private sector involved as well. So private sector, including supranationals like the World Bank and the IMF. but the government will have to focus on that as well. So, and I do believe that we need to work on upgrading our human resources, which in the form of education, healthcare, and overall skills. Because if you aspire to be a manufacturing, economy which is moving up the manufacturing chain, which is the stated objective, right? Manufacturing as a percentage of the overall GDP should increase to 25% from roughly about 18% now. So one of the things which you need to do is create a more a labor force which has the quality of labor force is better. And Hardika basically pointed out one of the issues, low labor force participation rate, especially among females. So you have to think of ways to address that. So I think the government will, but immediately I think the focus on building the infrastructure has to continue, because bringing down the cost of logistics in the country itself, facilitates exports at a time when the global economy is for the next couple of years is not going to grow more than 3%, and this is perhaps it's been lowest in quite some time, except for the global financial crisis period. I think this is not this perhaps is the lowest we've seen, and of course, barring the COVID year. So you will basically need to be more efficient when you are facing the external side, because one of the things which is holding back private capex is also the fact that your export markets are getting saturated. Uh, and of course, demand is domestically picking up, so that should facilitate. But I think, and
Agreed.
government has, and the capex is a multiplier, so it translates into higher capex by states, translates into higher capex by PSUs, and then eventually, and in fact, even private capex will step in, because manufacturing capacity utilization levels are reaching about 75%. That's where you typically start seeing investments come in.
Sure. I think there are a few more questions, but I think broadly we have covered them all. And time is also up, so I will stop here. But must say that very meaningful and realistic thoughts. Thanks, and let's hope that the finance minister and the team of the budget makers basically from the North Block listens to what we have discussed here and at least try to implement a couple of points there. Thank you, Tapanji. Thank you, Rajivji. Thank you, Gauravji. Thank you, Hardika ma'am, for sharing meaningful insights and being part of ETBFSI's budget series. Thank you so much.
Thank you, Amol, for having us.
Thank you, Amit.
Thank you, Amol.
Appreciate it. Thank you.
Thank you. Thank you so much.